All right, good morning, everybody. Thank you for being here, and I'm Stuart. This is our property wealth planning seminar coming up. And just to make sure before I go ahead, is everybody okay? Can you hear me? And if you can just let me know in the chat, that'll be appreciated. Thank you so much. Hi, everyone. Yes, loud and clear. Excellent. Okay, so I have some friends in here. So thank you for joining me this morning. And I've also got many of my friends who have invited their friends and their family members. And very happy to be able to share with you all today some of my insights. And hope everybody's well and preparing for the Christmas. And I'm actually quite surprised so many of you turned up. Now we have close to 100 people here and more tuning in. And some of them, I see Vivian from Australia, right? Yeah, some friends from abroad, some locally. Anyway, we are all here today for a common reason. We want to know where the real estate market is headed, right? So we can either take advantage of opportunities there or at least be able to look ahead and plan our finances, our retirement much better. So that's what I'm going to share with you about today. It's a Saturday, so I will keep it greetings from down under, Vivian. So I'm going to keep it simple and quick for all of you, as painless as possible. Sometimes you all know I can be quite lost for those non-Chinese friends, quite long-winded. Okay, so I keep it to the points I have. There are so much things I have to share, but today, because we have an hour and it's the weekend, I want you to have your weekend too. All right, so I'll just keep it straight to the point. So we're going to start right now. And the things I'm going to cover today include indicators that savvy investors use to determine their entry timing into the market. What indicators are we seeing in the market today, and how will it affect your upgrading and investment plans? Okay. How will understanding of market cycles also help you achieve higher returns in the next 3 years? Because what I'm seeing now is an opportunity. It's a great opportunity waiting us. So, and finally, what actions can you take as a HDB owner or a private property owner so that you can take full advantage of this coming decade of growth? Okay, so now without further ado, let's get into it. Now, first, just an update for those of you who are, following markets or not following the markets. In fact, so right now, what we are seeing in the US, in Singapore, is not a U-shaped recovery, not a V-shaped recovery, but more like a K-shaped recovery. I think you would see that all right in the news all over the world. Recently in the Straits Times, we have seen that the lower wages workers and certain segments of the industry are really suffering like the travel industry, the hospitality industry. But certain sectors are doing exceptionally well. Technology sectors, anything that's got to do with IT and generally financial services are still okay. And what we are seeing now is two-pronged then. It's a two-pronged recovery. The blue line being those in the usually higher wages category, and the red line, those that are in the lower wages category. And this can be further seen by the stock market's performance. If you monitor either the US market, if you trade the US, you trade Singapore or Hong Kong, you will see that, wow, stock markets have bounced back almost to the last highs or surpassing the last high already. So yeah, the what they say, the rich are getting richer, right? But in fact, in this time round, is those that are in technology in certain sectors that are doing especially well. Okay, so while there's so far in the past few months a crisis, there has been a lot of opportunities as well. Now, I just want to recap a little bit about how money flowed during the financial crisis in 2008, in case some of you are too young, you're not in the workforce yet, and maybe now you're just looking back at history. So what happened in 2008, and a quick overview for everyone here, is that the Federal Reserve began printing money in the US, and the Federal Reserve, who prints money as much as they want, it's like the money printing machine of the world, okay, because US is still the reserve currency. And since then, 3 quarters later, right, in 2008, that was second quarter 2008, 3 quarters later, the stock market saw very huge gains in the US stock market, subsequently flowed to Singapore. Singapore's market also rebounded. STI, the Straits Times Index, in Q1 2009, 3 quarters later. And then Singapore's real estate market rebounded in Q3 2009. That's 5 quarters later. So are there some similarities that we see this time round? Yeah, that's what I want to point you to, okay? Because there are a lot of signs out there, despite the fear and despite the negativity bias. You know, we sometimes gravitate towards negative news, and then we let it scare us, right? So despite all this, there are a lot of signs that, hey, things, we might already be out of the woods, and very much out of the woods. So that's why I want to draw some comparisons with. Okay, here you can see the increase in money supply, and this is in the US because, like I said, they are like the leading indicator of what's to come for assets around the world, okay, especially developed economies. So what we can see here is this. I'm going to draw on my iPad right now. The blue line, and hopefully you're on a big device, because if you're on a small device, you probably can't see very clearly. Okay, on the blue line at the top, that would be the property price index. Okay, and the red line, we are seeing the Federal Reserve total assets, and those are the sources that I got it from, all official data. And we can see back in 2008, at this point, okay, this is when money printing started in the global financial crisis, because we got into a very bad state, right? The financial sector in the world. Okay, and what happened next, right? A few quarters later, this was what happened. Singapore's property prices started going up, and it went on an uptrend for a while. The second stimulus came in somewhere here. Okay, you can see this. It propelled our market further up. Okay, further up. And then there was a third stimulus here that began. And you can see a very artificial curve going up. And at that point also, you can see our Singapore market also going up correspondingly. And at that point here, 2013, some of you will know what happened. The TDSR came in, a lot of restrictions that were very draconian came in to stop the market. Otherwise, Singapore's market would have gone like that, probably like that. Yeah, and then right now we will have a different problem. Okay. So thankfully or not thankfully, well, for those of us in the real estate industry, we were like, wow, volume really dropped. Okay, volume really dropped. Prices also came down. It took a breather for a while. Okay, was it a bad thing? On hindsight, no. It was a great thing to be done, because the bubble would have been too frothy then, and endangered our whole economy, a lot of livelihoods, even with such a sad growth. All right. Okay, and then with a few years of breather, because people got used to the ABSD, the lower loan to valuation limits, the TDS, all right? It took time to get used to. Plus incomes. Okay, incomes are not in this chart, but incomes along the way were still growing. Okay, were still growing. And it came to a point in 2017 where we can see another growth in prices. Okay, because finally incomes caught up. So fundamentally, at least we are strong. All right. Fundamentally, at least incomes can support. Do I sound softer all of a sudden? Okay, one of the uh, attendees here commenting. I hope I'm not sounding any softer. I didn't change any settings. Okay. Okay, all good. So subsequently, what happened in Q4 2019? And if you recall, Q4 2019, it was before COVID had a full blown impact. January 23rd was the time where it was a kind of a big thing, and March was like horrid, right? The fear, ultimate fear came in for the whole market globally. Like it was like doomsday. Okay, so we had another stimulus here, and a very, very strong stimulus in first quarter of this year from the US, and not only from the US, from Japan, from Europe, Singapore, of course, and many economies everywhere. Everybody were now collectively printing money because this is so unprecedented. Okay, so in contrast, if you look at where the global financial crisis, how much money was printed, and how steep the curve of this printing of money was, supply of money was, versus where we are today, you can see that, wow, this is dramatically once in a lifetime, like much more than the previous one. So yeah, hope it's once in a lifetime. But anyway, what we can see here, if I were to clear everything right now, okay, clear, okay, is that there is a very small gap here that we need to understand, is between property prices and money supply held by the world's reserve currency. And with this increase in money supply, money is always chasing after what? Use, good use, and chasing after quality assets. And the fact is, there's a lack of quality assets around the world. Okay, there's a lack of quality assets. You can print a lot of money overnight or over a few nights, but you can't print quality assets over a few nights. And that's the trouble. And people start to pour funds back into equity markets, and that's where we see things happen, right? We see stock markets around the world going up. and so forth, and subsequently property prices around the world. Okay. Now, what has happened then since COVID? Okay, we do a similar comparison of how money flows. What I'm sharing with you here is first how money flows. So you understand the broader scale of things, and then we can narrow down. Some of you already understand, and because you're financially very savvy, you do a lot of reading. But for those of you who don't read financial news or are not so interested in financial news, I know people who are not interested at all. Then I just want to share a little background. Okay, so in Q4 2019, we saw Federal Reserve. Oops, sorry. We saw Federal Reserve printing money here. Okay, Q4 2019. And 2 quarters later, okay, over here, we saw the US stock market rally. We saw the Singapore stock market rally. But the Singapore market is like kind of boring and it rallied by rallied and very soft rally, very muted rally. And understandably why also, because Singapore's stock market doesn't have a lot of tech stocks or sexy stocks like Tesla, your Google, your Amazon, don't have. Yeah, so we are made up of traditional industries. So it did rally, but not so much. But luckily in November, we did a pretty good rally, right? It's still not past the last highs though. Okay, and then what's happening next? If according to how funds flow and how people react, ultimately we're dealing with people with money in their pockets, those who are still gainfully employed, those who who are sitting on good equity in their properties or other investment vehicles. When they see opportunity and they see low interest rates, they make money from stocks. There's a human tendency to go and diversify. They won't want to keep all their assets in just one market, two markets, or a few vehicles. They want to spread it out or upgrade their house, right? Since they're staying at home more often nowadays. And very likely what I see, okay, is this 5 quarters later, the same real estate rebound. In fact, it has already happened. Yeah, what I predicted was actually Q1, right? 2021. In the past 3 months, and even in the current month, we are seeing really, really high levels of sales. We are seeing an asking and price gap, meaning we have a bid price, just like all markets have a bid price, which buyers are willing to buy. And there's always an ask price, right? Where sellers are willing to sell. There's always this gap. That's why middlemen like us are involved, so that we can bridge the gap and expectations of everybody. And this gap, usually when it comes to asking price, comes down a little bit here, 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 and then you close the gap. But what we are seeing is this gap drying up, right? This gap has just dried up, and for most markets, even HDBs are dried up. Dried up means what? Now you have a gap that is either the buyer's blink or the seller's blink. You either move up your bidding price for buyers or sellers move down. Okay. But what is happening here is there is no urgency to sell for most people because for those who are affected by the COVID impact, they have loan deferments, principal and interest deferments until December, then extended now until March. And is it going to taper away after March? It's likely not to be removed totally because it's also flagged out in MAS that in the news that if you remove it totally, we have a panic situation for some pockets of people. And then news is news, they sensationalize, or one news become read by everybody, and everybody thinks a lot of problems are coming up. So most likely it will be tapered off or even extended if things don't turn rosier by that time. So the situation is that buyers are now it's a seller's market. Sellers are the ones commanding their premium. Buyers are the ones buying up. And this is what I see across the agents that I train. I do a lot of training for my guys. They are all giving me feedback on the ground, the pulse on the ground, right? The pulse on the ground is that. And I can tell you these are all coming out before you even read the news because the news is always a lagging indicator. Yeah. So for those of you who are shopping right now for a home, and if it's a more expensive home, right, it's just going to get more expensive in all likelihood. Yeah, we just had a massive, massive crisis where prices came down and Singapore prices nary move a little bit. Yeah. So okay, and recent quarters we have seen already early signs of a rally, as I mentioned, across all segments. And afterwards, I'll show you the different segment price increases, what has happened, all right, in each of them. Okay, so one of the broad monitors and indicators I use of the global economy, because Singapore is just like a grass in the wind, we are so affected by global forces, and no matter how resilient we think we are, we need to rely on indicators. Okay, and S&P 500, the top 500 firms in the US. This is one of the indicators that I use when I see how confidence will flow, where money is flowing, and whether investors are coming out to play. Okay, as in this case, you can see that in recently the S&P 500 has gone up by 165% from the bottom. It recovered past the last high. This was the last high, right? This was the last high over here before we entered this correction. And you can see from then we had prices go up, and then this is the new high somewhere here. Okay. Now, what has happened then? Some investors, myself included, we take money off the US market. We start to, hey, I don't want to be overly just in the US market. I want to have some exposure in the Hong Kong market, some exposure in the Singapore market so that I diversify, right? Not all in stocks, some in REITs and so on. And then what happens? We see a lagging momentum from, okay, this was the last high in, this is the STI, yeah, before we collapse into COVID, okay, fear and everything, despair, losing hope, doomsday predictions, and then reading too much news, then fell down. Okay. And what happened then? We saw since then the recovery. Recovery is about almost 90% of pre-COVID times. Okay. And this is where we are right now, about 28 plus. And in November, uh, there was news of the COVID vaccine, right, by Moderna, by Pfizer, and that brought up market prices also because formerly there was a rally, but then it came down again because once again our market isn't as sexy or liquid or high volume trading and so on. So what we can see here, stock traders have entered the market again. People have made profits once again. Those who bought here at the lows are starting to make profits. And there come a point in time where their portfolio is oversold, overheld with your stocks. And can you enjoy, well, not say can you enjoy stocks, but rather can you hold everything in just certain baskets? The answer is usually no, right? We most likely don't want to do that. Yeah, so we want diversification. And of course, if you make money and you're staying in a 3-bedroom condo, you probably want a 4-bedroom, you want a 5-bedroom, you want a penthouse, you want a landed next, right? That's typical progression thinking. So the STI then, how do we know it's a correlation? There's correlation and it's a leading indicator of the property market. Well, let's take a look here. So what we can see here, the blue line, once again, the PPI, Property Price Index, non-landed to be specific. Why non-landed? Because non-landed makes up a larger proportion of the market. Okay, and the landed market is very small, so comparing that would not be very accurate or representative. And then we have the red line, which is the STI, the Straits Times Index. Okay, and you can see here, first, this is in 98. Okay, so I was very young then. So, but study history. Okay, so 98, financial crisis. And what happened? We saw that the STI moved up first before somewhere here, about 2 quarters later, before the property price index moved up. Okay, we at the same time also saw how prices came down for the STI, and subsequently the property price index came down, right? So also another about 1.5 to 2 quarters later, we saw how prices move up in the stock market here quite early in this time round, before this part where the blue ones started to move up, the landed market started to move up. So it was a lagging indicator. Okay, an early leading indicator for the landed market, for the property market. Okay, and then we saw how prices dropped in the STI and before the property market reflected that. And finally, we saw here what happened in 2008 when the market rebounded in early 2009. It was about another 1 plus to 2 quarters later. Okay, there we saw property prices increasing. Now, what is happening again? Okay, there's a high correlation of things happening, of course, because these are all Singapore market, right? Now, what is happening here now? Here we can see there's a rebound in the STI coming back. And for our property market is still very flattish. It's not reflecting such a huge growth yet. And will it happen then? Yeah, to me, the eventuality will happen. And my estimates of significant gains happening has been revised. It was initially, the first quarter. Now it's very likely to be second quarter. Yeah, because this time round, STI didn't recover so fast as the last time. Okay, but still, anyway, the first quarter to second quarter of 2021 still means that Yeah, those who need to do something with your homes and everything should do so ASAP. Okay, I hope I'm clear on that. Yeah, aside from that, these are all the very clear signals. But I want to ask you, uh, where do you think the crowd psychology is today? That's very important, because sentiments is everything. Sentiments is everything. If you're confident, you spend. You are fearful, you save, and you stay at home, right? You hide somewhere, So there are different habits and different actions taken by people who are in different modes. So if you look at this chart, can you tell me where you are? Okay, you can type in the chat if you want, just to keep you engaged also. And for you thinking about where do you think you are? Are you currently anxious? Okay, maybe we can look at this part. Okay, likely I don't think you are thrilled or euphoric, or excited. I don't think so. Most people are not at that stage yet, because the COVID, the vaccine is, not tested. We are still waiting for the leaders to take it before we are willing. Okay. Now, where are you? I think in March, right? A lot of us were in probably panic. Okay, in March, probably in panic mode here, or desperation or fear somewhere here. Okay. Where is the market now? For most people, okay, well, some people who lost their jobs, of course, they are probably still not feeling very good about it. They probably feel less hopeful or depressed. So we really got to watch out for our friends, and those who lost their job during this period of time. But for a lot of the market, they are hopeful mode, relief mode, that the eye of the storm has passed and the vaccine has been released. Whether it's effective or not, whether there are side effects or not, we still don't know. But for most people, they are there. Very, very few are optimistic. Yeah. Some maybe, yeah. But a lot are just hopeful and relief. And if you look at this market cycle, these are actually emotions, market cycle emotions, and markets are made up of people who make decisions. Okay. We are actually in a spectrum here. This spectrum is where there are low risk and greatest opportunities for gain, because people are not getting out yet. People are waiting for the news to reflect it's safe to go back in. People are waiting for that yet. Yeah, so not a lot. If once you go in when people are excited and euphoric and thrilled, wow, market won't go down, everything will still go up. Then that's very high risk. That's very low opportunity. But for most investors, they read the news and then they move in. They don't look at early indicators. They might not attend talks. Yeah, and it's a pity because then decisions made, right, do not realize the full impact, full profit. Okay, so you have the answer where you are today. Some of you have already put in the chat group, hopeful, relief. Yes, I think that's where most of the market are today. Okay, so next, once we understand people and their psychology, we need to know where the economic cycle is. Okay, earlier I pointed you to the different indicators from the stock market, to the local and overseas stock market, right? Now, look at this. This is the economic cycle. If you look at the different characteristics of them, can you tell me which part of the phase we are in, which phase of the economic cycle we are in? Okay, take a look. Where are we? It's not difficult to guess. Okay, are we in recession, where confidence is weak, confidence is picking up? Okay, inflation peaks, not really. Inflation is low. Production falling, production is resuming actually. Okay. Interest rates, short rates are interest rates. Short rates already dropped. Okay, not really dropping anymore. 1 year drops, yeah, dropped already. Okay, so it's past. Stock market bottoming, stock money already recovered. Okay. Commodities weak, yeah, relatively still weak. Property prices weak, also not true. Okay, so we are in fact out of this recession. Okay. We definitely are not here where the economy slows, enters recession, because we have been through that already. It's definitely not in a boom mentality. Okay, so where are we left with? Okay, now let's take a look at the characteristics of a recovery. Stimulatory economic policies. Yes, yeah, I think so. Definitely, it is so, right? We are getting so many freebies from the government, a lot of support from the government. Confidence picks up. Yes, it is. Inflation falling. Yeah, inflation is still low for now. Okay. Short rates, interest rates are low, yes. Bond yields are low, bottoming. Yeah, actually it's at the bottom, minus 0.6. Stock market is rising, yes. Commodity prices are rising, no, not yet. Property price bottoming, no. Property prices has kind of climbed back up, right? So we are somewhere between recovery and early upswing. Early upswing is where we see increasing confidence. We don't have healthy economic growth. Inflation is low, yes. Short rates, interest rates are neutral. Yeah, we are actually pretty stable now. Okay. Bond rates are stable. Yeah, it's very low. Okay, probably not yet. Very low. Stock market is strong. Yes. Commodities prices strong. No. Property prices picking up. Yes. Okay. So where are we on spectrum of things? It's very likely in between these two, and maybe we can say between here and here, somewhere here. And this is the most ideal time, in my opinion, to enter something. In fact, I put my money where my mouth is. A few months back in the middle of COVID, right? I already bought something. Yeah. So in August, I bought something because I am so confident that, hey, I couldn't find deals in the market. The way the government is behaving is very obvious. They want to prop up the market because the last thing you want now is a property market a correction or collapse. The last thing you want now when you're trying to stimulate jobs and consumption and confidence. The last thing you want is to create something else that pulls down the market. Okay, so that's why, right? I put my money where my mouth is. Okay, so Nasin Talib, very important. You have to practice what you preach. Okay, so HDB flats accelerating in price growth. This is another indicator that is important to understand. Why? Look at how it relates to our property price index. Okay, and HDB prices are actually a very strong. Is it like almost 90% of the market, right? A lot of people are staying in HDB flats, and prices haven't been growing since which date? Since 2013. Let me show you here. Okay, 2013, when we had the mortgage servicing ratio (MSR) introduced, it was like a glass ceiling for HDB prices, and a lot of HDB owners suffered. And I'm talking about resale owners, not the BTO first buyers from HDB. A lot of resale owners suffered. Why? Because they saw how their prices were kept under lead and prices came down because no longer were HDB loans so easy to get. No longer could they get buyers could pay them a higher price for it. There was no more COV, and that's the problem. And so a lot of HDB owners actually suffered losses, CPF negative sale. They got lower and lower price for the HDBs as the years passed. That was 7 years ago, right? And then the market came into a plateau. So it fell no longer. Okay, it no longer fell. It just went, you know what, it's okay. Yeah, this is the bottom of the market for HDB owners. We're not going to sell anything lower than that. Okay. And then the private prices grew. So to HDB owners, like a lot of them were very big tick. How come the government only help the rich, don't help us? You know? Okay. So well, I think the cows were hurt. And not only that, because I think okay, in my opinion, okay, it coincided with elections, right? So 2019 September, what happened? There was an enhanced housing grant stimulus that was launched. Okay, 2019 September. And that was pre-COVID. And it's very timely because, in fact, that is one of the reasons that's holding up the market very well now. I don't think they planned for COVID. No way. Okay, no one could tell. But what we can see here is very small, but very notable is this part where we see HDB prices in the past 4 months growing by a pretty steep gradient. Okay, and I'll zoom in here, see whether you can see it. I'll zoom in here. Okay, it's a pretty steep gradient, although it looks very small in contrast to the whole history of the market, but it's very steep. And the only last time we saw such a steep growth was in 2012, okay, prior to 2013, where the MSR, all the cooling measures came in. Okay, so is it something we should take note? Yes, it is. This is one indicator I find that will affect the market a lot because it already is, and we are seeing that owners of HDB flats are selling at above valuation. So I've seen how recently, and my team of agents, we have people who sold Woodlands low floor 30K over COV, Pongo 30K over COV, the other one 50K over COV, the other one has a bidding war for Circuit Road old flat, bidding war. Wow. Okay. So very interesting. This was something we didn't see just a few months ago or even pre-COVID. Okay. So we need to know that the masses HDB flats are accelerating in price growth, and this is already due to a stimulus that was launched in 2019, not even a COVID stimulus package. It was before that. And okay, and that affects the rest of the market because where are these HDB owners who sell going to buy? Some would buy back HDB, no doubt, but a lot of them are upgraders. Okay, later I'll show you. A lot of them are upgraders. There's a record number of upgraders pouring into the market, upgrading. Okay, upgrading because they are MOP owners. They're upgrading to private. MOP owners usually are pretty young, and as a result, they are tech savvy and they're employed. So that's the difference. Then they are stepping out to buy. Okay, so now let's take a look at another indicator, gold price. Okay, gold price. Some of you here might invest in gold. Okay, some of you might not. Like I do not because it doesn't give me any yield. Neither is it enjoyable. It can't be enjoyed, right? So take a look at the landed property price index versus gold. Okay, every time that we see the gold price rising, okay, a later growth in the market of landed market happens. So it is also what I call an early indicator of home prices. Okay, landed home prices. You can see that when over here, when there was correction, there was a recovery in gold prices. About 2 quarters later, what happened? We saw landed property price go up. Okay, and here gold prices go up, and landed property prices followed. The other time we see this is here when it started to grow in prices again. Okay, gold prices started to recover again, and then we see that the property price, landed property prices started growing, and this time around a few more quarters later. Okay, and then a correction, and then another strong growth in gold, and you can see this gap is the closest ever historically between our landed property prices and gold prices. So who buys landed properties? Well, usually the most affluent class, right? The most wealthy people, most of them will own landed properties because after owning a lot of condos, they think that hey, you know what? Let's buy a landed. Let's own landed. Let's own land because land is something everybody aspires to. Okay, so in that category, people who have disposable income and a lot of equity will be investing in different asset classes. Gold being one of them, the common ones, especially my parents' generation and that age group, right? Now, but come a point, we also know it's not yielding anything. It doesn't give you any use. It doesn't give you any enjoyment. So eventually, people know that hey, I don't want to be overweight on gold. Too much gold is no good. So I want to, if it's appreciating, I'm going to cut some of my, take some profits out and I'm going to invest in something else. And if they are in the investment class, they would likely go into properties again. Okay, stocks maybe, yeah, but perhaps they have that too. And where do you go? You go to a bigger lender from bungalows to GCBs. Okay, for example, from semis, they go to bungalows. Okay, so this is what I see also as a result of playing with a lot of numbers and seeing some correlations here and there. Okay, so another point to note, because our government is a very careful government and is good, okay, and they do not want us to overspend our budget on properties and property investments, because if everybody just invest and don't work, there's a problem also, right? So, and there becomes a bubble. Okay, so what is important is that the general nation, right, has very low liabilities. Okay, and this gap is widening. The red line is liabilities, the blue line is the index. Okay, what we see here is a widening of the price index. Sorry, the widening of the gap between liabilities and the property price index. And as a result, we know that hey, affordability is okay, it's not that bad. But once upon a time, if you recall, okay, from this moment, 2013, and prior to that, when prices really grew very fast, right, somewhere in 2010, when cooling measures came about, the government was drastically trying to cool the market at few points, total 8 points. Until 2013, they succeeded. Okay, why? Because they were trying to close the gap. Yeah, sorry, they were trying to widen the gap. Yeah, trying to make it, hey, you know what? Liabilities are growing. We don't want that. We want liabilities to drop. We don't want prices to grow so much. Okay, so at this point, they succeeded to bring down the market, and importantly, because of the prudence of the measures, right? A lot of people have been taking lesser loans than they can afford because of TDSR, and liabilities have dropped as a result. So the market is not frothy. The market is not published, not yet, at least. Okay, and then we take a look at household net worth and the property price index. Is it okay? Is it not okay? And obviously, I'll just keep it short here. Very simple. This is the smallest gap I've seen for household net worth versus property price index over the years. Yes, some people may lose jobs, but with net worth being high, they can still afford to hold. They can still afford not to panic sell the properties. And as a result, there was a duff. There was not many great deals in the market back in the past few months ago. Okay, so next, money supply. Okay, money supply and the property price index. Now we look at the Singapore money supply. Okay, money supply has also increased over the years in Singapore as a result of a lot of foreigners putting money here because Singapore's currency is very strong. We appreciate against almost everything in the world, from the USD to Australian dollar, to Euro to Japan yen, all the major currencies. All right. So as a result, we attract funds even though we pay very low interest rates to them. Yeah, because there's like a pseudo interest rates. You grow, your wealth grows when you park your money here. Okay, so with this increased money supply along the way, plus the printing of funds in US, which affects Singapore's money supply as well. If we don't grow our money supply, there's a problem when the other side keeps growing and we keep deflating against too fast. Then Singapore's export of services might not be possible because our Sing dollar becomes too strong. Okay, so as a result, what you can see here is a small gap as well in the money supply versus the property price index. And what does that mean? It means that once again, there are a lot of money chasing very few quality investment choices. Okay, our market is small, no doubt. No matter what you create, company you create in Singapore, within a few years, you can't expand deeper. You have to expand sideways regionally. You can't go deeper anymore, right? We all know that it's a small market. You can't go to a different state, and that's all the population we have, 5 over mil. Okay, so where does money flow then? That's why it always flows towards property in the end. And a lot of pressures are pushing up prices right now. Money supply, stock market wealth, profits, net worth, low liabilities. These are all pushing up property prices. A lot of us are staying home most times. Okay, something wrong with my formatting of the slides somehow. It was okay yesterday. But let's take a look at segment price trends now. Okay, so an overview, HDB resale prices have grown for 4 months straight. This was in October when the news came out. So prior to that, the 4 months prices have been very strong. There have been more flats selling at past $1 million. Okay, why? Also partially because people can afford to pay with the grants given to them by the government. Okay, the stimulus impact I talked about earlier. So there were higher income ceilings for home buyers. Prior to that, families were who bought flats, right? BTOs. If they are families 12K income and below, now it's 14K and below. For singles, 6K and below, now 7K and below. For ECs, 14K income became 16K income. Okay, you know what that tells me? That tells me that the government is supporting that prices move up a little bit because he's allowing more people, okay, of a high income to buy them. So he's allowing, they are, I would say, indirectly allowing prices to grow. Okay, so this is one notable point. Second thing, they are throwing a lot of money in to help first-timer singles with enhanced housing grants. Okay, and third, they have more support for families. So a lot of money as a result has gone to the market, and is a very fortunate event. Why? Because this increased money velocity. When these home sellers of HDBs sell and get back a good profit or a much sizable profit than before, they will usually then spend it somewhere, spend it in a larger house, in a private property, and so forth. Okay, so this is one of the stimulus impact before COVID. They're still helping the market today, and I can see here, it was launched in September 2019, and because it takes time for money to flow out, for transactions to happen, about 3 to 4 months, we saw that this growth in prices in the HDB market happened between January to February. Okay, and had it not been for COVID, very likely it would have started to climb here. But because of COVID, a few months of inactivity, we saw prices only climbing back in phase two when the markets opened. And this is what happened in the past 4 to 5 months already. Prices climbing up. Okay, this is the steepest gradient of growth since 2012. And a very clear indication, people will be out there flush with cash, looking to buy something else. Okay, and by the way, these people are not panic sellers or urgent sellers, loss of jobs. That's why they sell the HDB. Why? Because the loans have been deferred. Their principal and interest can be deferred. And there are people who opt for the strategy so that they can get a job and pay back their loans. So these people are not the desperate crowd. They are the gainfully employed crowd who are looking to upgrade. Okay, next we can take a look at HDB MOP upgraders. And this is one of another reason why demand is so strong in the market. With the stimulus, with people staying home more often, and with a lot of MOP sellers. Okay, MOP sellers, and this is from Orange Tea Research. What we can see is from 2019, 2020, all the way next year, and 2022. Okay, there's a lot more supply coming in the market that's hitting MOP, and people are looking to sell. Yeah, because they have seen how private markets have done well in the past, and HDB flats are not really growing that much in the past compared to now, and they want to jump in on that for various reasons. Okay, to upgrade. And in comparison, right? Why do I say it's a very high amount of supply? Because the average 10-year supply is actually here, 10,000, the dotted lines. Okay, and what we are seeing in these 4 years are record amounts of MOP, people coming out of the market to buy and sell. Okay, above this dotted line. There's 3 times more. There's about the average about 30K per year of these 4 years. Some people who have reached the MOP last year are not sold yet. This year they are still selling. Okay, and the next few years we can see that this crowd will be there looking to buy. Yeah, I hope I'm going at a good pace for you. There's a lot to cover, so I really want to share as much as I can. Okay, as a result, in November, we saw that condo resale volumes are up, prices are in fact up, and also the news also advertised that, their headlines, buyers sense the worst is over. Okay, so just know what the crowd is reading. Okay, the news headlines are probably what people are reading. Okay, and as certain headlines really do affect sentiments when they are going to be released in time to come. Okay, whatever has been released has been released. In the days to come, in the next few quarters to come, you will see lagging news of wow, what happened in the last quarter, what happened last month, and you don't want to be on the back foot. Okay, condo resale prices hitting 2-year high while prices increased 0.8%. There was also Straits Times, 16 November. Okay, and to summarize this part, we've looked at 3 sectors, right, that form the residential market: the property price index for non-landed, your condo, your apartments, okay, the landed segment, and finally the HDB segment. You would see that there was a dip in the private property market in the first quarter here, okay, over here. And there was a small dip. I was expecting something bigger, but it didn't turn out because government had a lot of very good cooling temporary relief measures for property owners. Okay, and of course the job sector. Okay, and then next thing we know, it started climbing back up. Okay, and then finally across the board, the recent Q3 2020, we saw green arrows across the board. Okay, in time to come, will we see even stronger growth? My own take is yes, most definitely. Yeah, unless government decides to pull back the stimulus suddenly for for certain reasons, but it's not very likely at this point. Okay, so understanding the capital growth potential of your HDB. Okay, once again, pardon the formatting, it just went crazy all of a sudden. Okay, if you are a HDB owner, what can you do? Now I shared with you indicators in the market, leading indicators, the pulse of the market. I also want to share with you what can you do, because a lot of friends ask me, hey, should I buy, should I sell, should I upgrade, should I sell one, buy two, or should I just sell my HDB? Well, it depends. Okay, not everybody is the same, and it's very easy to say just sell HDB. Yeah, and you may hear, you may read online, everybody's telling you to sell your HDB, right? But when's the best time to sell? Right? Which year is the best time to sell? Now, we have a study here that shows certain years are the best time to sell, certain years are not as good. Okay, and I'll just show you the chart, all right? Your 0 to 5th year, of course, you don't sell. For most people, it's the MOP period. Okay, so after the 5th year, what happens? there's growth. Okay, the 5 to 10 year, we typically see a growth of 2.65% per annum for HDB flats. So is it a good time to cash out and sell? The answer is, well, why not? Because you have made money, you can. Okay, you're making 2.65% growth per annum, even if you hold on to the 10 year. And that's above the CPF accrued interest rate of 2.5%. So that's important because you want to make sure that your asset price growth is more than CPF accrued interest. If not, you start to accrue negative sales, negative CPF interest, right? So it does appreciate you can sell, but is it the best time to sell? Well, let's take a look at what happens in the 11 to 15 year. Okay, the growth rate in the 11 to 15 year is 5.15%. Okay, so pretty good. Okay, so 11 to 15 year, if you haven't sold your HDB in the first 5 years of MOP, it's okay. 11 to 15 years, you still can sell. And in fact, 11 to 15 years, you might see more people paying you a higher price. Okay, take note, this does not mean all districts in Singapore. Although my numbers are taken from SRX and they are representative of the whole market, all the HDB towns in Singapore, they are not localized. So in certain areas, it's quite different, like Marine Parade. You will see that, wow, the older flats actually appreciate quite a lot. Why? Because Marine Parade doesn't have many new flats or any new flats at all. Yeah, so they don't have much growth for young flats. There's no young flats. They are all old flats. Okay, so you have to use your own discretion. Also talk to your friend from Navis about asking them to study for you all the localized micro markets. If you're in Pongo, if you're in Ghim Moh, what happens? What's the trend like so far? Okay, but so far we can see that 11 to 15 years is the highest growth rate, is almost double the CPF accrued interest. Okay, and for the growth rate between 16 to 20th year, okay, we can see that prices are only 1.97%. That's below CPF accrued interest. So if you're holding your HDB flat and it's 16 to 20th year, you might not see as much growth as before. And it's below CPF accrued interest rates means that you will be accumulating negative sales, negative CPF when you finally sell. So definitely for most people, if you can help it before the 15 year, sell it off. Okay. What is Navis? I had a question from my one of the attendees. Well, Navis is our group, and we are a group of realtors. So I'm one of the trainers for this group, and yeah, whoever invited you to this talk likely is a Navis realtor. So you can look for them. They will be able to advise you similarly, okay, on a more micro level. And what's happening with HDB flats between 20 to 30 years old? We can see growth is only at 0.57%, and it's very bad. It's below our inflation rate, it's below CPF accrued interest rate. And so for older flats, if you're considering buying them and hoping that you can in the future exit at a profit or even at the same price, it's very tough unless it's a very rare flat that somehow has some unique attributes. Okay, but do your best not to go into this category of holding it till this age. I know that you are able to get a pretty good rental returns, rental yields for HDB flats. But if those funds that are locked into HDB are in a private property, you might see better growth. And I will show you that afterwards, okay, in a short while. And then those flats that are in the 30 to 40-year-old, yeah, they start to depreciate by 0.7% per annum. And that's very risky to your wealth. And although it's very comfortable not to do anything, but you might want to cut your loss and move on to something else that has growth in place. If there's growth and there's rental yield, that's the best. You want two things: cash flow plus growth, capital growth, right? Not only cash flow and no capital growth. Okay, so to summarize, right, for HDB flat owners among you, between 2010 to 2020, and I did this recent 10-year study. Why? Because if you go anywhere before 2010, you will find that the rules are drastically different because there was no MSR, there were not so many cooling measures and so forth. So in the recent 10 years, the best returns years were actually between 11 to 15 year, followed by 5 to 10 year, followed by 16 to 20th year. Okay, and from the 20th to 30th year mark, returns dropped to about 0.57%, and that's pretty sad. And then flats within 30 to 40 years mark depreciated already. So have caution, use caution when you hold on to flats, okay? Just for the sentimental reasons. I know there's always sentimental reasons. It's your first home. Um, or because it gives you very good rental yield, but also look at it objectively if you want to preserve wealth and so that you can have better retirement. Now, how about those of you who are not HDB flat owners? If you are holding a 99 years leasehold condominium, okay, let us check out the same thing. What happens to the growth rate as the leasehold condo ages? Okay, okay, from the 0 to 5th year after TOP, it still grows. It grows by 2% per annum. Not fantastically generally, not fantastic generally, but still reasonable. It's just that it's below CPF accrued interest. Okay, CPF accrued interest affects everyone, not only private owners, also not only HDB owners, also private owners. So the longer you hold, and if the property price does not increase, and you're using CPF to fund it, it's likely that you'll see your negative still come around when you sell it some years later. Okay. From the 6 to 10 year, you actually get a very good return, 4% per annum averagely. Okay, in this study, just to clarify, because one of the questions is this, in this study, it takes into account only properties that are 6 to 10 years old between the age 2010 to 2020. Meaning, if in 2010 is 10 years old, okay, in 2020, in 2011 it's 11 years old, it is no longer inside this study. All right, it falls off the charts because it no longer qualifies. Okay, you have to be 6 to 10 year old, condo 99 years between 2010 to 2020 to qualify for this, so that we know we are comparing apples with apples. Okay, and the 11 to 15 years of a 99 years condo actually grew the most, 4.51% per annum. So if you're looking to sell upon TOP, there's actually no rush. You can actually get better gains after the 5th year, after 10th year, in fact. Unless you have something else you want to go to, like let's say I'm holding a studio and then just TOP, and I want to buy a 3-room now instead of holding a studio that's 700,000, I buy 3-room that's 2 mil. Then no choice. Then I would still change it, upgrade an asset. But if not, you can hold it past the 5th year, past TOP, and it will still grow in value. Okay. So 11 to 15 year has done very well, 4.51% growth. 16 to 20th year, still okay, 2.85% growth. All right. And 20 to 30th year, that's where growth really stagnates. And below CPF accrued interest, below inflation, and that's not very good. So you might want to sell off before you hit this range of this age range, so that you can still grow your funds. So generally, I tell my friends, if you're buying a 99-year leasehold condo, don't buy something that's more than 15 years. Yeah, not more than 15 years. Why? Because most people will stay at least around 10 years, averagely 10 years in their new home. If they buy it at 15 years of age and they're going to stay there until 25, that means there's a remaining 75 years lease left, and they can still sell at a decent profit. Probably not that much, but at least they don't lose money when they sell. Okay, but if they are buying to something that's very old, like 20 years old, 25 years old, 30 years old, and then staying another 10 years, 20 years, and want to sell for a profit, or at least retain whatever they put in, right? It's going to be way tougher. Okay, unless of course it's an en bloc property. Okay, we all know that unless it's en bloc potential, but not every property has en bloc potential. Okay, and that brings us to this. That's why there are certain categories of housing, condos that are 30 to 40-year old that has experienced greater growth than those in the 20 to 30-year category. And we can see this happen from this en bloc years of 2016 to 2017, where you see a growth in prices, and also 2010, when there was a lot of en bloc going on. Okay, so that means what? You want to go, you want to buy a leasehold condo, you can go very young, 0 to 5 years, you buy it, you can still expect to gain in the 11 to 15 year, 16 to 20 year. Or you go very old, 30 plus year, 40 years, so that you can hopefully get en bloc. But take note, your rental yield is usually quite bad. Okay, but anything in between, you would be better off letting go of them rather than retaining them. Okay. Yeah. So to summarize this part, the best returns years are usually 11 to 15 year, the 6 to 10 year, followed by the 16 to 20 year, and lastly, the first 5 years. Okay, so there's really no rush to sell unless you have plans to grow your funds further or to invest in something larger, because some of my friends like to hold something larger because the denomination is larger. When you own, when it grows by 10%, it grows a lot more. Okay, so from the 20th, 30th mark, 30th year mark, the returns drop to 1% per annum. Okay, not attractive at all. 30th, 40th mark, because of en bloc potential, it appreciates fairly decently, 2.71%. Okay. Once again, if you need a further study on what you're holding currently, whether you should sell or hold, or whether you should buy that particular condo, talk to our Navis agent, because they are all trained to help you to analyze this well, and to help you to plan your property investments better. Okay, after all said and done, now there are potential opportunities if you are bullish on the market. If you're a HDB owner, and assuming the market grows by 10%, okay, assuming the market grows by 10% the next 2 years, okay, well, would you rather hold your HDB flat that grows by just 50,000? Because a 500,000 flat will grow 50,000, 10%, or would you hold a 1.5 million private property that appreciates by 150,000? Because 150,000 can do a lot more, right? Of course, your installments are higher, but installments are paid over time slowly, and but you allow the asset to grow together with the market with you. If at the end of 2 years or 3 years, or 3 years after SSD, you decide that, hey, you know what, I still prefer to pay down my loans, you can always sell the private and buy back a HDB, and use the profits to pay down the HDB. Okay, so yes, and if you're a private owner and assuming the market gains at 10% in the next 2 years, okay, would you prefer to hold just 1.5 million private property that goes up 150,000, or if you can afford it, to decouple, to own two, so that each of them grow by 150,000, you'll be accumulating your wealth much faster than before. Okay. For those who can't do two because you only have a single income, probably one of your spouse is staying home, then you can also consider, instead of holding a 1.5 mil property, to upgrade to something that's a 2 to 3 mil. So at least the growth can be much better. Okay. Otherwise, there are also other methods like trust and so on, buying under trust and so forth. Okay, so to summarize, I want to let you know again about the market fundamentals, apart from what leading indicators are saying, apart from what you can do if you are bullish on the market. Okay, that a property market recovery is already in progress. And what are the signs, what are other signs, and what are the other pressures that are pushing prices up? Okay, we have seen the very, very slight correction in the market, so slight that it doesn't really appear much. And once again, we see growth has outweighed the corrections. Over the past 7 years, the correction was just about 12%. Okay, and this time round, okay, over here 12%. And this time round, from 2017 all the way till now, the growth is already 15%. But 15% is not a lot of growth yet. Why? Because in the past two bull runs, it was 60 over percent, 60 over percent, 39%. Okay, before that was crazy, 500 over percent and 200 over percent. Really crazy growth. All right. So 15% is still a lot of steam to go. And we just exited a kind of major crisis, kind of one of a lifetime, or hopefully, hopefully once in a lifetime. And 15%, so it's not likely to have another great crisis happening very soon. It's not likely the world is going to have that. Uh, Not likely, could happen, but not likely. Okay. So and there's a lot of growth still there. Okay, if you want to take advantage of opportunities, we can see that the unsold supply in the market by developers has also dropped. Okay, steadily. So what we were watching for this year actually was this: whether people would still be buying, investors and upgraders will still be buying when COVID is here. Well, the fact is developers' unsold supply has been decreasing. They have been selling, selling, selling. Okay, they've been selling pretty well. Of course, they are very sellable projects, popular projects. They are the least popular ones. But what we're seeing is a very steady sales number. So developers are not worried. During COVID, where fear was rampant, yeah, they were a little bit worried. Yeah, but now we are past that eye of the storm, and sentiments are much better. Okay, so this is one thing to know. The third thing, government is delaying land supply. Okay, during COVID and even now, government land tenders are longer than usual. They're giving 6 months to allow developers to assess and to make confident bids, right? Good bids. So government is holding back. Okay, they are holding back their supply and they are slowly releasing it so that not to have an oversupply situation. Now, ultimately, whose actions count the most? It's actually the government. If they hold back supply, means what? Means they want supply to stabilize. They want prices to be stable, and when it's stable and we're going to a recovery, what happens to prices? Sentiments are bullish, right? When sentiments are bullish, prices usually grow. So what I see as this invisible hand in the market, they do want prices to be stable, not for prices to drop. And in turn, prices is likely to grow. Okay, fact number four, we see strong interest by developers at recent government land sales. So if you follow the news, you would see this. Okay, recent site Yishun at Tanah Merah, there's a lot of bidders, and in fact, only one would win each site, right? So look at the list. There's about 14 to 15 bidders, and each of them have all these developers have very deep pockets, very low interest rate environment, and they need to top up the land bank because they are realizing that hey, our inventory is selling out. And the last round, some of them were slow to the game of land banking in 2016, right? Some very early developers that came out like Oxley, Chng, and they bought early before the others. The incumbents, the big boys were supposed to be ahead of the wave, right? A lot of them lost out. They were slower to pull the trigger. And this time round, before inventory drops to around the 16,000 to 20,000 mark, a lot of them are coming out to bid once again. Yeah, because they know without land bank, they can't be a developer, right? That's the raw ingredient. Yeah. And if each site has only one winner, you can see how many more developers are hungry for land bank. And as a result, some of them have also um, turned towards the private market. You can see en bloc interest reigniting recently. Guillemard site was sold for 93 mil. We see Yuan Xing Mansion in Geylang sold. Okay, so this year, while en bloc market, or rather while the COVID is in the market, right? Quietly behind the scenes, there's a lot of action by the big boys with a lot of funds and low interest. So en bloc interest is in fact returning in January this year. In fact, we did a crystal ball and this training. I calculated all the numbers and one of my predictions was 2021 will be a year of en bloc. Yeah, because the sell through rate is very fast and developers know when they have to top up this time round not to be caught on the back foot. Okay, and in fact, it's already starting from second quarter of this year. Okay, fact number six, we see no oversupply issues. Okay, we can see here that the average volume here, average completion, because people are always, in 2019, people are very concerned about oversupply. Suddenly in 2020, nobody's worried about that. Right? Delay, okay, construction delay. Okay, you can see here, in 2021, okay, the purple or the dotted line there is actually the annual supply of 13,885, 855. This is the average over 10 years. And in 2021, we're going to see a shortfall. Okay, 2020, we see a shortfall. This is only Q4, but the total is not so much. It's probably about 6 to 7,000. Okay, so it's shortfall. We see a shortfall here also in 2022 and a slight oversupply here and a slight oversupply here, very slight. Okay, and then in 2025, we see and beyond, we see very low supply. So what happens here is this: developers take about 4 years, okay, to 5 years. They're given up to 5 years to build and deliver the project. If not, they get penalties, right? ABSD, QC charges. So coming to 2021, if you are a developer and you know that, hey, 2025 and onwards, basically here, this part is not going to have a lot of land competition. So what happens when there's a supply shortage here in 2025 and 2026 and so on? What happens if there's a supply shortage? Very likely we will see that prices will climb, right? So if you're a developer, would you want to hold land bank during this period of time, during this period? Yes, I would love to. I need to hold anything. I hold anything also will go up because supply shortage. Now, guess what? They are also reading the same thing. And they will know that in order to qualify to sell by this time, to complete by around this time where people will be buying and so on, okay, they will have to start bidding for land 4 years ahead, 5 years ahead. And if you take 2025 and 1, 2, 3, 4, okay, 5 is actually here, you will realize some of them why they are buying in 2020 or 4 why they have to buy in 2021. Okay, so if you look back in time, because construction takes time and they will need 4 to 5 years, they have to start buying land by 2021. So the question is, if 2021 you're going to the market to buy together with all these developers, what's going to happen? Yeah, you know what happens in every en bloc, right? A lot of money pours into the market, and block people get their windfall of 1 million, 2 million, 3 million, and then what happens next? They have to buy a home still. They may put some in certain other investment vehicles, but they will still definitely put into real estate, okay, or at least replacing their home. All right. So an en bloc market typically bodes very well and buoys up the whole market when it happens. Now, fact number 7, we see high average occupancy rates. They're still over 93%. No doubt it has climbed up. Okay, it has climbed up, but our rental rates for HDB, for private homes, are still very stable. In fact, HDBs went up in prices recently. Okay, and although it's about 6+%, right, of vacancy rates, but we must know that we are not even at the top yet. Okay, in 20, this is 21.6, and 20 over here, another peak here, right? Peak here and peak here, 21.7. These were years where the market started booming, despite vacancy rates being at 8% and 7%. So are we still safe? Generally, we are still good. Okay, and it really depends when the travel bubble will be, resume between more countries and everything settles down before vacancy rates can start to drop again. Okay, but in the meantime, there's not much urgency on that too. Why? Because the delays in completions for most projects, construction in the market, there are delays in completion, and these delays in completion means that people cannot move in as early as they hope, and this helps to take up the vacant supply currently. Okay. Fact number 8: construction costs will be higher. Okay, and this is evident in the news. Lawrence Wong came out to say, no doubt construction costs will rise with COVID testing. And this was just yesterday. Okay, we saw labor crunch contractors, labor crunch contractors hit by rising costs, supply chain disruptions. That's why delays in construction is going to happen. Delays in completion means that there's really no worry of oversupply in the meantime. But costs are rising, meaning the upcoming land that's being bid and bought by developers, right, will likely incur higher costs of raw materials, labor, and everything. And once again, these are pressures, right? When new costs are going to be higher, whatever's in the also see more, higher prices as a result. Pressure is moving up. Okay, so just understand there are more facets to the real estate market. The next thing is low interest rates visibility. As investors, we need to know when interest rates are going to rise. And Singapore tracks the US Federal Reserve rates. And what we see so far is that what they have announced is that interest rates will stay near zero through 2022. And the reason for this is to give confidence to businesses to grow. If you are a thriving business during COVID, please hire more people. Please expand your plant and machinery. Please buy more stuff so that you will create more jobs. All right. So in the near term, at least till 2022, we are likely to see interest rates staying at this rate currently, 1.3 to 1.5%, likely not to grow a lot. Okay, and this is good for us because rental yields generally averagely are about 3%. So they're still good. Okay, but what I see is that these sub 2% interest rates are likely to last beyond 2025 even. Why? It's not just 2022 is going to end. It's not going to suddenly climb up in 2022. I don't think so. Why? Because after the global financial crisis, interest rates took about 10 years to recover to 2%. Okay, you can see over here, 2008. Okay, what happened? 2008. This is 2%. This is 2% mark. Okay, so it dropped below 2, 2008, all the way before it hit another 2% temporarily, just a short while before it dropped back. That was almost 10 years, 11 years. Okay, so is it likely that this time round we see interest rates rising so fast, past 2022, 2023? The answer likely is no. Okay, if the past round of a less severe crisis took 10 years, I have no doubts this time round it will take longer or equal to that at least. Okay, so if you're not buying in a low interest rate environment, something is very wrong. Yeah. Okay, you should be, I would say there are good loans and bad loans, credit card loans, car loans, are usually bad loans, right? Very high interest rates. They don't make money for you unless you use your car for business. But real estate loans, interest rates are very low, and if the asset can grow in price, it's a very good positive carry. Okay, it's a good positive carry trade. You're making more, and your cost of funds is low. It's time to be more aggressive. Okay, it doesn't pay to be too safe because you see on the sidelines, the waiting game usually costs you money as well. Okay, because money is depreciating. Okay, finally, the last fact to share with you is the Federal Reserve, right, in the US, the inflation rate targeting has increased to more than 2% per annum. Okay, prior to that, it was 2%. It was their standard. Let's try to hit 2% inflation every year. And for most developed economies, inflation is good, but moderate inflation within the 2% band. But because in the past, since now they have not been able to hit this target when they target less than 2, okay, or 2, they target 2, they can't hit 2. They are now targeting more than 2, so that hopefully they land on 2. Yeah, it's like aim for the moon, you land on the stars kind of concept. Okay. And what happens when the biggest economy still, okay, until China comes about, okay, targets higher than 2% means that inflation is going to be higher in the future compared to the past. Okay, and means that the world will slowly start to follow this because well, inflation affects us all. We are very globalized, we are very connected, we buy from each other, and it will pass on to us. As can be seen, next, after the US announced that more than 2% inflation targeting, right? What happened? The ECB also wait whether they should copy them because they too want inflation and they have to, shoot above 2. Yeah, so that there's a balance of buying power. There's a balance of not letting certain like currencies be too strong and as a result suffer from exports. Okay, so what I see is that more aggressive inflation globally is underway because low cost of funds is one, but because the leaders of these nations of the world are starting to target higher inflation. So the eventuality is it will happen because they have resolved to make it happen. All right. To sum it up here, I would like to put into comparison what common investment choices Singaporeans make, right? So I update this quite frequently. So recently in November, I updated this, and this is a 10-year comparison of what we have generally invested in over 10 years and how well has it done. As you can see, right, over here for ECs, they have done the best over 10 years. Yeah, and I debase everything to 100,000 so that for ease of comparison. Okay, so of course you won't find 100,000 easy or any home for that matter. Okay, so returns include exclude initial capital. From 100,000, it became 191. Okay, that's a return of equity of 191%. Okay, and if at a certain point you rent it out because it's capable of being an income generating vehicle. Okay, if you rent it out after the 5th year, okay, you get another 37%. Okay, you can see over here 37% returns. Okay, and if I adjust for the trailing decades inflation, which is 17.6%, right? After adjusting for it, you'll still be making like 210% over 10 years, which is the best out of the lot. Okay, second to that will be condo, 140%. 100,000 will become 140,000. With rental calculated, if it's a 10-year rental, right, you will get about 214%. Okay, and adjusted for inflation, almost 200%. Still pretty good. Landed properties did third best, 119% return on equity, and adjusted for inflation, 175%. Gold did not bad. Okay, you get about 38% return on equity. Okay, but adjusted for inflation, just 20%. There's a very big gap between the top 3 and the bottom. Okay, the rest of the bottom ones. CPF ordinary account, where a lot of us have money in. After adjusting for inflation, at least it still preserve your purchasing power, still 10% growth, right? Okay, fixed Ds, not very good. Fixed Ds about 3.4%. Okay, you break even barely. Okay, HDB flats in the past decade didn't do so well. Okay, returns on equity was 16% here, adjusting for inflation. And if you had rented out, right, for 5 years, you have rental income from the HDB, you probably get about 53% over the past 10 years. And then trading inflation, after inflation, right, adjustment is about 35%. If you put in a bank account, please don't do that. I have a friend who does that, and yeah, I'm not too sure he's listening in, but please don't do that. Yeah, it's very bad. You are smart and you should be investing. You know, you put in a bank account. Okay, STI. Sadly, STI isn't doing very well, and after adjusting for inflation, it's minus 36%. Okay, I didn't go into individual stocks like DBS, OCBC, Singtel, SPH, and so on, like SIA, because everybody chooses a different stock. It's very hard to weigh. So I weigh the index so that you can see. Being based in Singapore, we should be invested in properties as much as possible. It's safe, it's not so volatile as you can see in the past few months, even with the volatility in the market. Property owners are by and large very, very comfortable. Okay, so if we don't take advantage of this opportunity, it's a pity because foreigners who come in have to pay ABSD, PRs have to pay ABSD, so much money, while we have the privilege of buying without ABSD. Okay, so we should maximize whether it's a couple, your husband and wife, or you buy in a trust or kid. If you can, buy. Okay, because unless things change, very likely Singapore will still be the way it is within our generation, hopefully, and attract a lot of foreign capital. Okay, so well, our Navis agents are trained in this process called property wealth planning. So whoever invited you to the talk, please have a word with them if you need any help planning your property investments, planning whether you should be selling or buying, or what affordability, what can you buy safely and still afford it. So let them help you with clarity and walk through the different methods of helping you to acquire passive income. Choose the right property is very important. We don't just want to sell you a property, but we want to help you to find the property that can make money for you and help you grow your wealth, because that is more meaningful. Right, one-time transactions is a very is a very bad thing. Okay, so there are also many ways involved in this property wealth planning landscape. Okay, there's different methods as you can see here, from stretching tenure, refinancing 2-to-1 borrowers, part purchase, buying under trust, mortgage withdrawal loans, income boost, and even all the way to private banking, term loans, and so on. These different strategies can help you to lower your installments, so it's more affordable to own more properties. It's not so cut and dry that you own two means you pay higher installments. There are ways to lower your installments every month, okay, to lower your cash requirements, to help you plan so that you structure your tax optimally. You pay minimum tax if possible. Save on tax, not avoid tax. Save on tax is legal, avoid tax is not. Okay, to help you increase your returns. All right, and for those of you who want higher leverage, to help you get higher leverage. Okay, so our guys are trained in this, but please look for those who have invited you for the talk, because apparently if they do, make the effort to invite you, I'm sure you mean something to them. That's why they want you to listen to this and attend this talk. All right. Okay, next. How do you determine the highest investment potential projects? I will briefly run through, because today's session is not about this, but I just want to let you know that all these contexts, these data are available to our people. So we go by a few factors. We call it the PPMH, how to find the right property. Okay, first, the price per square foot. Okay, is it the lowest in the segment? Okay, by lowest in the segment, I mean you have to compare apples with apples. If you're comparing a freehold with a freehold in the same district, then it's fair. But if you're comparing freehold with 99, then it's not fair. But what we want is if you do want to go into a new launch, buy the lowest price one possible out of that area, out of that segment. Okay. Second, profit margin of developer. Okay, profit margin of developer. Is the developer making less than 20% profit margin? Okay, preferably so, but not compulsory. Preferably so, not compulsory. Okay, why less than 20% is good? Because usually if they start to sell a new launch and they earn less than 20%, they would raise price in subsequent phases. Yeah, it's kind of called the loss leaders concept. Like Harvey Norman, they advertise in the newspaper, this TV going at below cost or at a cost price. You go down, then you will buy that and buy some other things, right? Yeah, maybe you would lah, but they are banking on that. So you use a loss leader to have some sales, and then towards the second or third phase, right, of a launch, they will make back the initial uh this profit that they wanted. Okay, preferable but not compulsory. But because it gives you a better margin of safety when you buy. So we have also identified which projects have this attribute which you can capitalize on. Okay, third, MRT. Is it close to a MRT? Because in a study by Property Guru, most people, 60% prefer a location within 10 minutes walk. So you want to be able to buy and sell it someday, right? Or rent it someday to someone. and find it easy rather than difficult, because it's 15 minutes, 20 minutes away, no MRT, and then people don't want to buy it from you. So exit becomes a problem, right? So you really want to be within 10 minutes walk. We have also narrowed down all the options for you. And then a hotspot, is it located within a URA growth hotspot? Because you would want to bet where the government is betting. Yeah, simple as that. In the past, we have seen how Sengkang grew in prices. We have seen how Punggol grew in prices, and it's still growing in prices. We have seen how Tampines grew in prices in areas where government, Jurong, especially Jurong, wow. Okay, we have seen wherever the government place their funds in, they do grow. Yeah, so you want to be there so that you ride on the government's growth, okay, plans, and the investments are going to point to the area. So where are these places? Once again, we have done all the all the hard work and already have narrowed down. Okay, now, these top projects within growth hotspots, this is a sample. We have an entire list that's always updated to reflect the changes in the market, and they go by all the different, all the different attributes I've pointed out, and we use that to determine as scientifically as possible how to get a good outcome for our clients. Okay, so that whatever you invest with us and our people, there's a higher chance you make money. There's no guarantee in this world, and investments are always, there's always, everything carries risk, right? But at least there's a highest chance that it's not just sales pipe. So for the sample, this is just a sample. If you want a complete updated list, please talk to the one who invited you today. Yeah, they would have the list available to send to you. All right. Okay. Okay, finally, we're coming to the end. How long? Wow, I overshot a little bit. Okay, so as you have witnessed, this is my parting shot to you. Inflation is as certain as death and taxes. Okay, the fundamental solution we see that the world's government has adopted is to print money, okay, and to combat COVID. And in the coming decade, it's critical that we buy assets that can help us to take advantage of this, because this eventuality is things will go up in price. Yeah, assets will go up in price. And holding cash, as we know, because of the inflation targeting by the governments of the world, holding cash means that we will depreciate. It will depreciate, and as it has done historically. And if you hold 20 years of cash, means you're going to lose like 2% of 20, it will be 40%, and you should avoid that at all costs. Okay, and have more proactive management of your wealth and money. And Singapore properties, not just because I'm Singaporean and an investor. Okay, Singapore properties are likely to outperform the different asset classes, because we have done a few updates, and all the time Singapore properties come up the top three all the time. Sometimes it's landed, sometimes it's EC first, sometimes condo first. Okay, and because we are still attracting a lot of global money, and there's a very strong Sing dollar. So very thankful we are here, and we should be making full use of this privilege we are born with. Okay, this blessing we are born with. Okay, so that'll be all from me, and I hope that the session was useful to you. It's 12:30. We have to cut it. I know you got to go for lunch and family gatherings. Thank you so much for being here, and hopefully you got something useful for yourself to base your investment decisions. And all the best. Merry Christmas. Okay, wish you all the best. Keep your chins up. Market is getting better, and if anything that if you need anything that you want to ask me, please just ask the agent who invited you today. If there's some questions, direct it to them. If they were to approach me, I'll try to help as much as I can. Okay, right, that'll be all. Thank you so much, guys. See you guys. Bye.